Okay, let's unpack this. We are diving deep into General Mills today.
Ah, GIS. Yeah, a name everyone knows. Think Cheerios, Betty Crocker, Pillsbury.
Exactly. Just feels like the bedrock of the grocery store center aisle, doesn't it?
Yeah.
150-year-old consumer staples giant, over 100 brands, famously stable, famously, defensive, non-cyclical.
Well, and that reputation, that's kind of the crux of the issue now, isn't it? That cloak of stability is feeling a bit heavy.
Now, so,
Because while the sector is defensive, I mean, people always need to buy food, right?
right,
Non-cyclical hasn't really meant stable for them lately. Not at all.
right.
So our mission today really is to figure out why this company, built on that very stability, is suddenly seeing, well, frankly, severe drops in earnings,
Yeah.
and why they're pouring, what is it, $2.1 billion from selling off a major business into this huge and, I'd say, high-risk strategic pivot.
And how they plan to fight back. Because they're in a real scrap, aren't they? This ferocious price war against private labels, store brands.
Exactly. It's threatening the profitability of their absolute core business.
So this deep dive, it's really about the cost, isn't it? The cost of trying to win back that consumer.
Yeah, we need to break down that strategic trade-off. Where's that $2.1 billion going? What did they have to give up to get it?
And the big question, can this accelerate plan they keep talking about actually, save that legacy portfolio? Because the competition on price, it's just brutal. It's destroying margins.
It really is. We're looking at a business in what should be the safest sector, consumer staples, but its performance lately, well, it's been anything but safe.
The tension's definitely high. Okay, let's start at the foundation then.
Ah.
Right, the sheer scale of this empire, General Mills, GIS for short, it's global, manufacturing, marketing.
Oh, yeah. Huge logistical operation. They've got factories in, 13 countries? And they're selling brands in over 100. It's massive.
It's a massive machine.
It is. But, that size also means it can be slow to turn. The sheer scale and, frankly, the maturity of a lot of their business makes driving really high, sustained organic growth across everything.
Well, it's tough, inherently challenging. So their strength, their moat, really comes down to the brands themselves.
Almost entirely. It's the power, the recognition of that branded portfolio.
And what a portfolio. I mean, 9 iconic brands, each doing over $1 billion a year in retail sales. That's incredible.
It really is. You mentioned Cheerios. Blue Buffalo is huge now. Nature Valley, Betty Crocker, Pillsbury, Old El Paso. These are household names.
You're more than names, they're kind of cultural touchstones, aren't they?
Absolutely. And that brand equity built up over generations, consistent quality, massive marketing spend, that's always given them huge advantages.
Like what specifically?
Well, better shelf space in stores, for one, better terms with the retailers, and, crucially, pricing power. Some ability to charge more than, say, the store brand.
And that power shows up in the market share numbers, right?
Oh, definitely.
Yeah.
You walk down that center aisle, you're basically walking through General Mills territory. They've got, 31% of the U.S. ready-to-eat cereal market?
31%.
Oh. Makes them the biggest player, by far. And in baking mixes, they own half the domestic market. 50%.
Okay, the dominant sounds good, almost bulletproof.
Yeah.
But you mentioned vulnerability. Where does that come in? Is it how the company's structured?
That's exactly it. The segment reality check. When you break GIS down, they have 4 main reportable segments, right? But the problem is they lean incredibly heavily on just one. And that concentration risk, that makes the whole company fragile if that one core business starts to wobble.
Which one is it?
That's the key thing for anyone listening to grasp right away. The health of General Mills is overwhelmingly tied to the North American consumer, period. The North America retail segment, or NAR.
NAR.
It's their biggest, their oldest, their most critical segment, and it accounts for a staggering 61% of their adjusted diluted earnings per share.
61%. Okay, wait. So for every dollar of profit General Mills makes, 61 cents comes just from selling cereal, baking mixes, that kind of stuff in the U.S. and Canada.
Pretty much, yeah. On retail shelves. So
Yeah.
You see the problem. If NAR catches a cold, the whole company ends up in the ICU.
Exactly. That massive dependence is why this current downturn is hitting them so hard.
What about the other parts? You mentioned 4 segments.
Right. The others are important strategically for growth and diversification, but they just don't swing the needle like NAR does.
Right.
You've got North America Pet. That's driven by Blue Buffalo, the big acquisition a few years back.
Right, the premium pet food.
Yeah, that's their key growth engine now, but it's only contributing about 13% of EPS currently. Then there's international, that's around 14%. And North America food service, selling to restaurants, schools, etc., that's the last 12%.
So 13%, 14%, 12%, compared to 61% from NAR.
See, when NAR loses volume, like it has been, that 61% share just hammers the company-wide earnings immediately. Severe pressure.
Okay, so if the big plan is to shift towards pet food, which is only 13% now, and away from the core NAR at 61%, that just highlights how huge and, frankly, painful this transition has to be.
It's a classic dilemma. You've got this massive, usually reliable cash cow, but when it gets sick, the whole farm's profitability tanks. Okay, let's trace how NAR got sick. For decades, consumer staples felt, well, almost invincible, right? The idea was consumers always buy food. Demand stable, predictable, doesn't really matter if the economy's up or down.
Yeah, that's the sort of macro high-level view. But the reality on the ground is a lot more nuanced.
How so?
Well, okay, the quantity of staples people eat might stay roughly the same, but the mix, what specific products they buy, and crucially, the price they're willing to pay for the premium brands, that's super sensitive to economic pressure.
So when budgets get tight.
Exactly. People might still buy pasta, right? But maybe they switch from the familiar branded box to the store brand to save a buck or two.
And the big trigger for that switch recently was inflation. Just massive inflation starting in 2022.
Oh, huge. Commodity prices, sword grains, dairy, energy, transportation costs, everything. U.S. food prices jumped, what was it, 9.9% in 2022?
Almost 10%.
And then another 5.8% in 2023. I mean, that's the highest food inflation we've seen in a generation. It just crushed household budgets.
So General Mills, like everyone else, had to raise prices to protect their margins.
They did. But here's where the competitive dynamic got really interesting and kind of tricky for them. It happened in two phases.
Okay.
Phase one, peak supply chain crisis, 2021 into 2022. General Mills' size actually gave them an edge. Their supply chain was more resilient. They could keep stuff on the shelves.
While smaller guys struggled.
Exactly. Smaller competitors and, really importantly, the private label manufacturers, they had major out-of-stock problems.
So GIS was winning simply because the cheaper option wasn't even there?
Pretty much. And they used that window quite aggressively to push through significant price increases.
Okay, makes sense. But that sounds like a temporary advantage.
It was, and it quickly flipped into a fatal disadvantage. That was phase two. Started in 2023, really ramped up into 2024.
What happened?
Global supply chains normalized, things started moving again, and suddenly competitors and private labels were back on the shelves in full force.
And crucially,
at much lower prices. Way lower than where General Mills had pushed theirs. And this just exposed a huge, unsustainable price gap.
so the shopper, already hurting from inflation everywhere else.
Now had a choice again. A readily available, often pretty good quality option that might be 20%, 30% cheaper than the Cheerios or the Nature Valley bar they used to buy.
And management couldn't ignore that. I remember seeing the CEO, Jeff Harmening, basically admit it publicly.
Yeah, that was a big moment. He said the company's value equation was out of line with what consumers' expectations were. That's basically saying, yeah, we priced too high.
A huge admission.
It really was the pivot point.
Yeah.
Because the consumer reaction wasn't subtle. It was aggressive, fast, and sustained downtrading.
People switching brands.
Not just switching premium brands, but moving wholesale to private label, store brands. We can see it really clearly in that critical U.S. cereal category, you know, the heartland for NAR.
Yeah.
Private label market share there went from about 5.6% in 2021 up to 9% by late 2024.
Wow, that's a big jump. Almost double.
It's a massive shift. That 3.4 percentage point gain, that's billions in sales that used to go to branded players like GIS, now captured by store brands.
And that volume loss, that bleeding of customers, hit NAR directly. The 61% segment.
Painfully direct. The NAR segment saw a devastating 4 percentage point drop in volume for the full fiscal year 2025. That's not a blip. That's a serious structural headwind.
Needs immediate action.
Desperate action, really. The problem wasn't that people stopped wanting cereal. It was that they stopped wanting to pay that traditional hefty brand premium for it.
And that realization that the brand name alone wasn't enough protection anymore forced their hand into this massive strategic shift we're seeing now.
Exactly. They had to do something drastic.
Okay, but hang on. If NAR is so dominant for GIS, why didn't we see quite the same level of, public pain from competitors like Kellanova or the food parts of PepsiCo? Was GIS just uniquely exposed?
That's a really good question. I think there are two key reasons why GIS felt it maybe more acutely. First, Just the depth of their market share in those specific categories like cereal and baking mixes, they're the biggest target. So when downtrading hits cereal, it hits the number one player, GIS, the hardest.
Okay, makes sense. Bigger they are, harder they fall kind of thing.
Sort of. And second, you could argue their pricing actions back in phase one were, well, maybe a bit more aggressive than some others. They really prioritized protecting their margins during that supply chain chaos.
And that created that wider value gap the CEO mentioned later.
That's the thinking. They maybe overshot a bit more fiercely, and when the alternatives came back, the consumer backlash, that shift to private label, was particularly strong against them.
Okay, so the diagnosis is clear.
Mm-hmm.
Chronic volume loss in the core business. Needs major surgery. And the prescription is this accelerate strategy. It sounds like
Yeah.
reshape everything.
Yeah.
Prioritize new growth, even if it means cutting loose some big old but stagnant parts.
Yeah, it's a classic corporate turnaround playbook, really. And it requires some pretty drastic moves. The biggest, most visible one, selling off their entire North American yogurt business.
Yoplait and Wee brands. Gone.
Sold for $2.1 billion.
Wow. $2.1 billion. That's serious capital. But, I mean, wasn't that yogurt business huge? Like $1.5 billion in sales.
Yeah.
Why cut something that big, that recognizable?
Because it was basically a strategic dead end for them. The U.S. yogurt market had fundamentally shifted.
How so?
Greek yogurt happened, Chobani primarily. Yoplait was the classic traditional yogurt, but consumers massively shifted towards Greek yogurt, higher protein, different texture, perceived as healthier, more premium. Yoplait just lost its relevance, lost share year after year.
So it was big but stagnant.
Exactly. Stagnant, low growth, probably pretty capital intensive too. It was sucking up management attention without delivering any real momentum. Selling it was an exit from a losing battle.
Okay, so they took the hit on the top line. We saw that, right? A 4 percentage point drag on net sales growth in the first quarter of fiscal 26 because that $1.5 billion just vanished from the books.
Right. They sacrificed that revenue to free up the $2.1 billion in cash, believing they could deploy it much more effectively elsewhere.
Trading a known, slow future for maybe a riskier but potentially much higher growth one.
Precisely. Which leads us straight to where that money went. Growth driver number one. Accelerating pet food.
Blue Buffalo and beyond. This is the new engine, right?
Absolutely. Targeting that huge long-term trend of pet humanization.
Yeah, that's undeniable. People treating pets like furry children, spending crazy money on premium healthy food. Sometimes more than on their own food.
It's a massive market, and General Mills is pouring that yogurt money in. Not just growing Blue Buffalo from within, but also buying up other companies, Whitebridge pet brands in North America, Edgard & Cooper over in Europe, expanding that premium natural pet food footprint globally.
Okay, so M&A is part of it, but what's the big internal bet, the really new thing?
The really fascinating, and I'd say highest stakes, part of this is the upcoming launch of Blue Buffalo's Love Made Fresh. It's a line of fresh, refrigerated pet food.
Whoa, okay, refrigerated, that's
Yeah.
that's totally different for General Mills, isn't it?
Totally. This isn't just a new product line. It fundamentally changes what General Mills is operationally.
Explain that. Why is refrigerated such a big deal for them?
Because, look, General Mills built its entire 150-year fortune selling shelf-stable dry goods. Cereal, flour, baking mixes, granola bars.
Yeah.
Stuff designed to sit on a pantry shelf for months.
Right, ambient temperature, long shelf life.
Exactly. Launching a perishable refrigerated product like Love Made Fresh that requires a massive leap in operational capability. It's probably the single biggest execution risk in the entire Accelerate strategy.
What are the specific risks? It sounds like they need a whole new infrastructure.
They absolutely do. Think about it. They need huge capital spending CapEx to build or refit factories with cold storage. They need a bulletproof cold chain from the factory to the refrigerated truck to the back room of the grocery store, right onto the refrigerated shelf.
That sounds complex
Yeah.
and expensive.
Incredibly complex. We're talking refrigeration logistics, much shorter shelf lives, higher risk of spoilage, managing that limited refrigerated space in stores. If that cold chain breaks down anywhere truck malfunction, store cooler issues around, the product quality is gone instantly. And the premium brand image, destroyed.
It's like asking a company famous for making bricks to suddenly start delivering ice cream nationwide.
That's a pretty good analogy, yeah. They have to nail the execution. flawlessly to justify selling off yogurt and betting big here.
Okay, so that $2.1 billion starts to make sense. It's not just investment in pet food, it's investment in becoming a cold chain pet food company.
A huge chunk of it must be for that new capability, yes.
But while they're making this huge risky pivot outwards, they can't just ignore the core, right? It's 61%. And NAR still needs fixing.
Absolutely not. That's growth driver number 2. Restoring North America retail volume. They have to stabilize the mothership.
Hell, they've mentioned some framework, remarkable experiences.
Yeah, that's their marketing buzz phrase for it. It involves innovation, brand building, all that stuff. The absolute central component, the unavoidable reality, is value.
Meaning price.
Meaning price. They have to make targeted price investments,
Yeah.
aggressively narrow that price gap between their brands and the private label options that have been eating their lunch.
But wait, if they're cutting prices now after raising them so much,
Yeah.
how do they avoid just completely tanking their profitability?
Yeah.
Especially if input costs, ingredients and energy, are still pretty high.
It's a really tricky balancing act, and it's
Yeah.
a calculated sacrifice. These aren't, blanket 20% off sales everywhere. It's more strategic, targeted promotions, maybe different pack sizes at key price points, things designed specifically to disrupt that private label momentum and maybe tempt shoppers back. They're essentially trading some immediate profit margin to try and win back the habit of buying their brands and get that volume flowing again.
Is it working? Are there any signs these painful price cuts are actually bringing shoppers back?
Well, that's the crucial question, isn't it? And we do have some early positive signals. This is really the main ammo for the bulls right now.
Okay.
In their first quarter results for fiscal 2026, General Mills reported that they managed to hold or even gain pound share, actual physical volume share, in 8 of their top 10 U.S. categories.
8 out of 10. That
Yeah.
sounds pretty good, actually.
It suggests that the strategic pricing, the promotions, they're starting to bite, maybe getting some of those downtrading consumers to think twice and pick up the branded box again. But, and this is huge, but doing this is incredibly expensive.
Mm-hmm.
Which leads us right into the financials. #4, financial status and the investment year.
Okay, let's quantify that pain. We know NAR volume was down 4% in fiscal 25. That deceleration must be hitting the overall company numbers hard.
Oh, yeah. Fiscal 25 was the warning flare. Net sales dipped 2% overall to $19.5 billion. And adjusted diluted EPS, that key profit metric investors watch, that fell 7% in constant currency.
Not great for a stable company.
Not great at all. But Q1 of fiscal 2026, the quarter ending this August, that's when you really saw the full impact of this strategic pivot hitting the bottom line hard.
Yeah, those Q1 numbers look brutal. Reported net sales down 7%. Now, some of that was the yogurt sale disappearing, right?
Right, that $1.5 billion annual run rate just vanished. But even organic net sales, stripping out divestitures and currency effects, even that was down 3%. So the core volume problem is still there.
And the profit.
Oof. The bottom line took the full hit from those price investments and probably higher costs for things like the pet food expansion. Adjusted diluted EPS fell a sharp, painful 20% in constant currency, down to $0.86 a share.
20% drop.
Yeah. This isn't just, a bad quarter slipping through. This is management actively choosing to sacrifice current profit to try and regain that future volume.
Which is exactly why they're calling this whole fiscal year, FY 2026, the investment year, isn't it?
Yeah.
They're basically telling the market, expect pain.
And they're being pretty blunt about how much pain. The full year guidance is unambiguous. Organic net sales, somewhere between down 1% and up 1%, basically flat to slightly down.
Okay. And the profit outlook.
That's where the real hit is. Adjusted diluted EPS for the full year, guided to decline between 10% and 15% in constant currency.
Wow. A double-digit profit decline forecast from General Mills. That's rare.
It's highly unusual for a blue-chip staple company, but it reflects the cost of this reset they're paying now to hopefully grow later.
And what's really interesting, or maybe telling, is that they reaffirmed that negative guidance even after reporting that awful 20% drop in Q1.
Exactly. That's management signaling, look, we knew Q1 would be bad. The 20% drop, yeah, that was anticipated. It's factored into our plan. Stay the course.
Builds some credibility, maybe. But the immediate impact is just margin destruction.
Severe margin pressure. Those price investments mean they can't just pass every cost increase onto the consumer anymore. The Q1 numbers showed it clearly. Gross margin fell 90 basis points. The adjusted gross margin, Stripping out some items fell even more, 120 basis points,
They're actively shrinking their own profitability per sale.
to fix the volume problem.
Yes.
Which means their famous cost-saving program, HMM, holistic margin management, that becomes absolutely critical now.
It's not just for boosting profits anymore.
No way. It used to be a way to add a bit of extra profit growth each year. Now, it's basically life support.
Life support. How so?
Well, HMM is how they find efficiencies, right? Streamlining logistics, negotiating better prices for ingredients, tweaking recipes to save costs without hurting quality, all that stuff. Before, those savings padded the bottom line. Now, those savings are absolutely essential just to fund the price investments, to pay for this price war they're fighting.
So if HMM underdelivers,
The whole plan falls apart. They can't afford the price cuts needed to regain volume without HMM generating enough savings to offset a chunk of that margin hit. The guidance becomes impossible.
okay, so operationally, it's turmoil. Margins are under fire. But despite all that, General Mills is still a cash machine right now. Yeah. That's got to be their saving grace.
It absolutely is their foundation. This company throws off a ton of free cash flow, consistently over $2.2 billion a year.
And that predictable cash flow underpins the most famous thing about GIS stock.
The dividend,
Oh, yeah.
paid without interruption for over 120 years, that's an incredible track record, almost unmatched in corporate America.
And because the stock price has come down with all this bad news, the current yield is pretty juicy, right?
Yeah, the forward yield is up there around 4.8%, maybe 4.9%, which is attractive in today's market. And importantly, that dividend looks pretty safe.
Even with profits guided down 10–15%.
Because of the cash flow, the payout ratio, the percentage of earnings or cash flow paid out as dividends is still in a healthy range, around 58% to 60% based on that free cash flow. So even with the EPS drop, they should generate more than enough cash to cover the dividend payment.
Okay, so the dividend provides a strong incentive for income investors to stick around, maybe wait for the turnaround.
It definitely puts a potential floor under the stock price,
Mhm.
but we have to talk about the other side of the balance sheet, the debt.
How does that look?
They're carrying a significant amount, $14.41 billion in debt. A lot of that is still left over from when they bought Blue Buffalo back in 2018.
For like $8 billion, wasn't it?
Something like that, yeah. A huge deal. And it leaves them with a debt-to-equity ratio of around 1.52x. That's manageable, but it's not insignificant. It definitely limits their financial flexibility, especially right now when things are tough operationally.
Let me push back on the dividend safety for a second then. High debt, profits falling double digits. Why is the market apparently so confident that dividend is secure? Is it just trusting that 120-year history? Seems a bit like blind faith.
It's not entirely blind faith, I'd argue. It really comes down to the cash flow versus accounting earnings. While the adjusted EPS is falling sharply because of things like those deliberate price investments hitting the margin, the underlying free cash flow generation is expected to remain pretty robust.
Okay.
So the thinking is, they generate over $2.2 billion in cash. The dividend costs, what, maybe $1.4 billion? There's still a cushion there, unless the actual volume collapse gets way, way worse than anyone is currently forecasting. The dividend seems covered by cash, even if accounting profit looks ugly.
But the debt still matters.
Oh, absolutely. It means they probably can't go out and make another big splashy acquisition right now, even if they saw an opportunity. Their hands are a bit tied financially during this investment year.
Got it. And all this uncertainty, this risk, it's clearly reflected in how the market is valuing the stock, right? It's trading cheap.
Dirt cheap, honestly, compared to its peers. The price-to-earnings ratio, the PE, on a trailing 12-month basis, it's around 9.5x.
9.5. And what's typical for big packaged food companies?
The peer group average is closer to 23x right now.
Wow, that's a massive discount.
Huge. Even looking at it another way, enterprise value to sales. GIS is around 2.1x to 2.25x. That's below its own 5-year average of about 2.58x.
Okay, let's decode that PE cap. A peer average of 23x suggests investors expect, decent, stable, maybe moderate growth. A PE of 9.5x that just screams, we think growth is going backwards or staying flat forever.
That's exactly what it signals. The market is pricing in negative growth, or at least structurally impaired profitability. They are deeply skeptical about this accelerate strategy actually working long-term.
They don't believe the margins will ever recover.
Or that the volume recovery will be strong enough. The market's basically saying, prove it. And that elevated 4.8% dividend yield, supported by the cash flow, that's the compensation investors demand for taking on that risk. It's the potential safety net, the valuation floor, while they wait and see if this turnaround actually takes hold. #5. Risks and the turnaround roadmap.
Okay, we've laid out the strategy. Sell yogurt, bet big on fresh pet food, cut prices on cereal. It's definitely high stakes.
Yeah.
So let's be clear about the roadblocks. What could make this whole thing just fail? What are the key risks to this turnaround thesis?
Number one absolutely has to be execution risk, specifically with that pet food pivot.
The refrigerated love-made fresh line.
Exactly. We talked about the complexity, the new supply chains, the manufacturing, the cold chain logistics. It's totally outside their historical expertise if they mess up that launch, like widespread quality problems, spoilage issues, retailers struggling to handle the short shelf life. If that product gets a bad reputation right out of the gate, it could completely undermine the credibility of the entire portfolio shift. All that investment, that $2.1 billion, could be largely wasted.
Okay, huge execution risk on the new stuff. What about the fix for the old stuff? The price cuts in NAR.
That creates its own massive risk, competitive risk. They're cutting prices to narrow the gap with private label. What happens if competitors, Kellanova, Post, maybe even PepsiCo's Quaker brands, just match those cuts? Or if the private label guys lower their prices even further?
A price war.
The nightmare scenario, a race to the bottom. If everyone just keeps cutting prices to steal volume back and forth, it just crushes margins for the entire industry. General Mills could spend all this money on price investments, erode their own profitability.
And end up right back where they started on volume, but with permanently thinner margins.
Precisely. That would be a disaster.
Then there's the bigger picture question about the shopper. What if this isn't just a temporary reaction to inflation?
That's the structural risk. What if this period of really high inflation has permanently changed how people shop for staples? Maybe consumers tried the store brand cereal, realized, hey, this is actually pretty good, and they're just not willing to go back to paying that big premium for the name brand anymore.
Especially if the economy weakens further.
Exactly. We could see a permanent structural shift towards private label. If that happens, then that brand equity moat that General Mills is fighting so hard to defend is just permanently lower. They might win back some volume eventually, but they might never get back the pricing power they used to command.
Which would basically validate the market's current low PE ratio, suggesting it's a long-term problem.
It would imply the company is structurally less profitable than it used to be. And finally, there's the financial risk we touched on.
The debt.
Yeah, that $14.4 billion in debt, the 1.52x debt to equity. It's manageable now, but if this operational downturn drags on longer than expected, or if they need more investment capital than planned, that leverage limits their options, makes it harder to borrow more, harder to keep funding share buybacks, maybe even puts pressure on the dividend down the line if things get really bad.
So the balance sheet isn't exactly a fortress providing cover right now.
It's more like a solid wall they really can't afford to run into. Needs careful management.
Okay, let's try and synthesize this for listeners trying to weigh the odds. What's the core bull case here? Why would you take the risk on GIS right now?
The bull case hinges on believing this pain is temporary, but the strategic change is necessary and ultimately positive. So, 1, the stock is historically cheap, 9.5x PE versus peers at 23x, huge discount. 2, the dividend is secure for now, offering that high 4.8% yield while you wait. 3, management isn't burying its head in the sand. They're proactively tackling the core volume problem with price investments, even though it hurts profits now. And 4, they're aggressively pivoting into a proven high-growth category, pet food, which provide better long-term growth and diversification. They're making the tough choices today for hopefully a better tomorrow.
Sacrificing profit now for growth later.
Okay.
And the bear case flips that.
Completely. The bear case says, 1, that volume weakness in the core NAR business isn't temporary, it's persistent. Private label quality is good now. Competition is fierce. Those shoppers might not come back in big numbers. 2, the margin compression from this price war. That's likely sustained, maybe permanent because the competitive landscape has changed. 3, that big bet on fresh pet food. Way too risky. High chance of execution stumbles, meaning they sold a stable, if slow, business just to fail on a complex new one, and
Therefore, the stock stays cheap. That 9.5x PE is actually fair value for a company with these structural headwinds.
Exactly. The bears think the turnaround won't materialize or will cost too much for too little gain.
Okay, so if you're watching this unfold quarter by quarter, what are the absolute key things, the KPIs you need to track to see if this accelerated strategy is actually gaining traction? What tells you if the bulls or the bears are winning?
You got to watch volume, margins, the pet segment, and keep an eye on the competition.
Okay, first,
NAR organic pound volume. Actual physical volume in the core North America retail segment. This is the ultimate scorecard for those price investments.
What do you need to see?
First, stabilization. Stop the bleeding. Get that negative trend to flatten out. Then you absolutely need to see it turn consistently positive within, say, the next year or so. That proves they're winning back share.
Okay, number 2.
Gross margin trajectory. This tells you the financial cost of winning that volume.
Need to see it go up.
Not necessarily right away. First, it needs to stabilize. That shows the HMM cost savings are working hard to offset the price cuts. Then, yes, ideally, you want to see it start to gradually, slowly expand again. If gross margin keeps falling quarter after quarter, it means they're losing the war on both volume and price. Very bad sign.
Got it. Third key indicator.
Pet segment, organic sales growth, and market share. Is the new growth engine actually firing?
How fast does it need to grow?
You want to see strong growth here. High single digits, ideally low double digits. That validates selling the yogurt business, justifies the investment, and proves the whole portfolio pivot makes sense long term. If pet growth stalls, the whole strategy is in deep trouble.
Makes sense. And finally, you mentioned looking outside the company.
Yeah, number 4 is an external check. Private label market share trends, specifically in those key GIS categories like cereal. You can find this data from market research firms.
What are you looking for there?
You need to see private label share stabilize or ideally start to tick down slightly. If store brands keep gaining share rapidly despite GIS's price investments, it means the strategy is working. It signals GIS is failing to defend its brands against the cheaper competition no matter the cost.
Wow. Okay, this has been a really fantastic deep dive. It paints a picture of a company truly fighting for its future, doesn't it?
Yeah.
The core tension is just so clear. You've got this iconic 120-year-old business, the cash cow.
Right, the cereal and baking mixes.
And it's currently in this brutal volume war. And they're using the cash flow from that struggling business to fund this massive leap into a totally different, modern, super complex category, fresh pet food.
It's an incredibly delicate balancing act, probably the biggest corporate transformation challenge happening in the consumer staples world right now. They're not just selling products anymore, they're fighting to maintain habits, brand trust, and perceived value in a world where value is being seriously redefined.
Which leads perfectly into maybe a final provocative thought for our listeners to chew on.
Go for it.
Okay, so General Mills is taking this immediate, significant profit hit. That 20% EPS drop in Q1 is proof all in the name of winning back volume. But here's the big question. Is that century-old brand equity, the power of names like Cheerios or Betty Crocker, is it still truly defensible against store brands when the quality gap has shrunk so much? Or has this global inflation shock permanently lowered the premium people are willing to pay for any brand name on packaged food, signaling a fundamental long-term shift in the industry that might keep those margins squeezed forever?
That is the multi-billion-dollar question, isn't it? Has the spell been broken? Definitely something to think about.